My name is Ernie Humphrey. I'm the Vice President of Educational Programs for Performative, the online community and resource for corporate finance, accounting, treasury, and related professionals. First, I'd like to welcome everyone to the webinar, Global Currency Markets, Turning Currency Volatility into Business Opportunity. Volatility is the only certainty in modern currency markets, and businesses have become much more sophisticated in managing the associated risk. However, this has meant that many are failing to harness the opportunities that market movement can create. Understanding the sources and nature of currency volatility can present opportunities for companies to drive top-line growth by leveraging volatility to establish competitive advantage. Our webinar today will feature renowned global currency market expert Karl Schamotta, who will offer an assessment of current and emerging global currency markets, what is driving the volatility in these key markets, and focus on positive aspects of currency volatility, highlighting strategies companies can use to harness different types of currency movement while remaining protected against downside risk. I would like to thank Western Union Business Solutions, whose commitment to thought leadership helps make this event possible, like everything else at no cost on Performative. A quick note on today's agenda. Again, we'll first hear a presentation from renowned currency market expert Karl Schamotta, and then we will conclude with an interactive Q&A session that I will moderate, where we will spend the remainder of our hour. We would like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get to all of them, but we will do our best and we'll follow up afterwards on any questions we did not get to. Before we get started, a few more logistical notes. We will post this presentation to the Performative site where it will be freely available, and we will send you a link to the deck as well later today. We are also offering CPE credits for the CPAs in today's audience. Finally, before we get started, a quick word about Performative. Performative is the largest and fastest growing online resource for senior level corporate finance, treasury, and accounting professionals. Performative offers a uniquely noise-free and valuable online peer network, direct subject matter expert advice, and features and resources developed in direct collaboration with our constituency. I'd like to get us started by introducing our speaker today, Karl Schamotta, Senior Market Strategist, Western Union Business Solutions. Karl has designed and implemented risk management and trading strategies for hundreds of companies, ranging from small businesses to large corporations. As a member of the Business Solutions Analytical Team, Karl also provides market analysis and strategic guidance on a daily basis for thousands of international businesses. Karl is a regular contributor to a number of international treasury and finance magazines, and his market analysis and forecasts have been widely quoted by such publications as the Washington Times and the Wall Street Journal. Karl is a member of the Professional Risk Managers International Association and the Global Association of Risk Professionals, and is the president of the Association of Finance Professionals in Calgary. With that, I'll turn it over to Karl. Karl?
Thank you very much for that introduction, Ernie. I guess you could sum that up with I'm a huge foreign exchange nerd. It's great to be joining the Performative audience again today, especially at such an interesting inflection point in the markets. Equity markets have been rocket-propelled for months. Commodity markets are rallying, and a steady drumbeat of positive news has been coming out of the U.S. economy really since November. Investors are riding high, and businesses are feeling optimistic once again. And you know, this is after several false starts over the past few years, and the world really does appear to be in recovery mode at this point in time. I was talking with a reporter this morning about this situation, and we were laughing because the markets appear to be feeling no pain right now. And we've seen volatility drop in the foreign exchange markets, and that's actually caused many corporations to stay on the sidelines and not hedge themselves against future upsets. And this really reminds me of something that the famous value investor John Templeton used to say. He used to say that the four most expensive words in the English language are "this time is it's different." So true. Whenever I hear that, my contrarian instinct comes to the surface, and I begin to assume that some sort of upset is in the offing here. And that's interesting because contrarianism is often misunderstood to be negativity or bearishness, but this is really to misunderstand what the chaos in the modern financial markets really represents. It represents equal parts risk and opportunity. Traders and businesses that know how to harness this opportunity and harness the opportunity part of that equation love times like now when the world is relatively complacent about the future. So today we're going to talk about why so many of the contrarians like myself are experiencing a sense of deja vu, sort of a sense that we've been here before. We'll then delve into the philosophies that your business can apply in order to seize the opportunities that are being created. So really the question is this time really different? Let's look at recent history to find out. Let's start with this chart, and you know, full disclosure here, I start almost all my presentations with this. One, because it's so scary, and two, because it had such an impact on what has happened over the last few years. It shows the monetary base effectively doubling in the United States in the space of 2 years. In the wake of the financial crisis, the Federal Reserve electronically created new money and credited it to the reserve accounts of the major commercial banks in an effort to drive interest rates down and kickstart lending. For people holding paper cash, this was a very, very concerning chart to look at. But for traders, it was not scary at all. It meant that trillions of dollars in new cheap money was headed into the financial system. And after all, traders absolutely love cheap money. As a matter of fact, it was soon burning a hole in their pockets. They scoured the world for trading opportunities, and they immediately seized on the obvious one, China. As this chart illustrates, Chinese GDP barely dipped in the aftermath of the financial crisis and continued to soar higher. So clearly it made sense to borrow in the United States and invest in China. Unfortunately, there was a little bit of a wrinkle here. China did not actually want the traders' money. It maintained and continues to maintain capital controls that are specifically designed to keep hot money out. So traders looked for the next best thing. They started buying the things that China would need. They bought commodities, raw materials that would be needed as China built infrastructure and as its citizens became wealthier. So fueled by this narrative and in combination with cheap money, commodities rallied, with energy and metals prices almost doubling in the post-crisis period. The long-term historical average for crude oil was around $25 a barrel prior to 2008, but spot prices were soon back above the $100 mark in the aftermath of the financial crisis. At the same time, traders borrowed in the U.S. dollar and they bought higher-yielding currencies, particularly commodity exporters. In the currency world, we call this the carry trade. Money was being carried from the United States and invested elsewhere. And you can see the effect quite clearly in this chart. You can see a huge divergence between the U.S. dollar and currencies like the Aussie and the Kiwi and the Canadian dollar there. But there was really a darker reality behind all this. And, I often refer to this quote. Mencken said, "For every complex problem, there is an answer that is clear, simple, and wrong." I think it's a great quote because it really does narrow down what happens to us in many areas of the economy. We take a very complex subject and we boil it down to something very, very simple. And in this case, there was something hiding behind that reality, and that was that that big, scary money supply chart was just too simple to explain what was really happening in the real world. It turned out that the vast majority of the Fed's money remained stuck in the reserve accounts of the major banks. They weren't willing to lend it out, and businesses and individuals were even less willing to borrow it. Loans actually fell, as you can see here, meaning that while interest rates were very low, there was a very limited flow of money going out into the world. And this is actually something that Ben Bernanke kept trying to tell people, Ben being the chairman of the Federal Reserve. But no one was really willing to listen to him at the time. They looked at that initial chart and they assumed that a lot of money was about to flood out of the United States. But in early 2011, something came out of left field to derail the carry trade. Problems in Europe boiled over, interbank markets seized up, and people started to seriously contemplate a Greek default for the very first time. I think this next slide is almost amusing. As you can see, it's almost as if the world had never heard of debt before May last year. But within a 3-month period, everyone was suddenly aware that Europe was in trouble and that debt was a very serious issue. So what happened was that we had a neutral money supply reality in the United States combining with the possibility of contagion in Europe. And this caused the carry trade to collapse. And it's interesting because a lot of people did not see this outside of the financial world. But last year, currencies took off in a variety of directions with no clear pattern emerging. And this meant that currency speculators and hedge funds that were involved in this market lost their shirts in the process. This was an extremely, extremely painful year for many people who were looking to make money out of the trends that had emerged post-crisis. But this time was really no different. The European Central Bank soon stepped in to save the day. And this is an astonishing chart in a lot of ways. Much as its counterpart in the United States did 2 years ago, the ECB began to print money. Almost €1 trillion was added to the European financial system between May last year and now. The ECB's balance sheet is now almost a third larger than the Fed's. You know, we had this happening in Europe, but we also started to see something promising in the United States itself. Loans began to recover, not quite to pre-crisis levels, but borrowers and lenders were once again willing to tango. And as a leading indicator, this implied that the United States would begin to stabilize. And indeed, it actually has. If you look at the economic data that has been coming out of the United States over the last 6 months, you can see a steady improvement in the amount of money that is flowing through the economy. So what are traders doing with this reality, with this new narrative? Well, as Warren Buffett likes to say, a pack of lemmings looks like a group of rugged individualists compared with Wall Street once it gets the concepts in its teeth. And this is very, very true. There's very much a herd mentality out there, and there's a mentality that we're going to focus on one simple idea and we're going to run with it. So traders are back at it. This time they aren't borrowing in the United States, they're borrowing in Europe and Japan. You can see here that the carry trade is back, but in a slightly different form. So this time we're seeing the yen and the euro acting as funding currencies. Traders are borrowing in euro and the yen, and they're lending into countries that export commodities. Very, very clear divergence here. Amazingly, at the same time that this is occurring, we're seeing a drop in volatility expectations as people become more optimistic about where the global economy is going. They're becoming less concerned about moves in the markets themselves. This is the Chicago Board Options Exchange Market Volatility Index, or the VIX. It's a measure of the implied volatility in S&P 500 index option prices. It is often called the fear index because it measures the market's expectation of volatility over the coming 30-day period. And as you can see here, we've had several lows in the VIX over the past 5 years here. And in general, each of these has preceded a spike in currency market movement. Each of those lows has led eventually to a spike in movement in the markets themselves. Currently, we're trading near 15%, and that is an extraordinarily low level. So the question here is this time different? Has the world recovered to the point that we're looking at stability in the coming months? Here I'd argue, and you know, I'm going to throw another quote in here, but this is from Benjamin Graham, and I think this is incredibly good advice. And it's advice, by the way, Benjamin Graham is considered a mentor to Warren Buffett, very much a fundamental investor, but he says that in the short run, or he said that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. The stories that drive the markets today eventually fade, and new realities take their place. This has happened time and time again over the history of financial markets, and it will continue to be the case as long as human beings actually drive trading activity. There are a number of fundamental developments occurring right now that are unlikely to let us off the volatility hook for the foreseeable future. In the United States, the economy is rapidly restructuring, moving away from the debt-fueled consumption that defined the early years of this century. Businesses have rationalized their operations, and they have increased efficiency to the point that productivity has surged to world-class levels. Earnings have risen as a result, and this has lifted spirits in the markets. But housing markets remain incredibly subdued. The Case-Shiller index, for example, continues to fall. So consumers have taken a terrible psychological blow here and remain extremely cautious and largely committed to the reduction of debt. Very, very few consumers are willing to spend at the levels that we saw prior to the financial crisis. Now, this has a second-tier effect. Because a large part of the American workforce grew up and was trained in a consumption-driven economy, the United States is now facing a long-term structural unemployment problem, and this is one that won't go away for weeks. Won't go away in a period of weeks or months. Workers must be trained, and new businesses must spring up in order to hire them. And this means that improving jobless roles that we've been seeing in recent weeks and months are unlikely to gain a lot of momentum going forward. And this means that the odds are that investor expectations have risen a little too high over the past 6 months, very much as Ben Bernanke said on Tuesday in his testimony. But in the big picture, that which has not killed the American economy has made it stronger. The longer the businesses can survive without the morphine that domestic consumption provides, the more competitive the United States will become on a global basis. The future is certainly brighter than it has been in a very, very long time, and investors know this, so money is steadily coming home after spending years abroad. Now, of course, there's some contrast here. Across the pond, the euro area is facing an extremely different future. Due to the vast amount of new money that has been poured into the financial system over the past 6 months, the liquidity crisis that brought the continent to its knees last year has been largely averted. And this is contributing to the global sense of optimism. Funds are flowing between banks once more within the euro area. However, the reality is that the liquidity crisis was simply a manifestation of a much larger economic problem, a much larger competitiveness problem. If anything, the risk is that all of this free money acts to remove the sense of urgency that compelled reforms over much of the last year. Huge competitiveness gaps have been papered over thus far, and the euro area itself will have to undergo a profound restructuring in order to forge a sustainable future. Until this happens, the ECB's money isn't likely to flow into the real economy, and this is very much an echo of what we saw in the United States 2 years ago. Unfortunately, though, a true restructuring is becoming less likely by the day. Where we had political cohesion over the last few years, because you had Merkel and Sarkozy sitting in positions of power, populations across the common currency area are now feeling extremely aggrieved. And this is creating a bit of a distortion in the political arena. Countries like Germany, which are effectively paying for the profligacy of their southern neighbors, are being contrasted with countries like Spain, where people are being forced to endure harsh austerity measures that are really imposed from outside. And Spain's budget, by the way, tomorrow will really exemplify this. If it's too generous to voters in Spain, the external world, the bond markets and the policymakers will be disappointed. But if it is too harsh, voters will be extremely angry and the political party in charge will be under threat. So while elected policymakers, as I mentioned, that have been in power for a while, remain largely committed to the common currency project, the voting public is actually turning in another direction. In France, for example, Nicolas Sarkozy is very likely to be unseated by a socialist challenger in the coming weeks. And Hollande, the challenger, has openly suggested ripping up some of the euro area treaties and starting over. So now the thing here, though, to think about is whether this gives you a sense of deja vu. It does for me. It really draws a comparison between the United States 2 years ago and where we are now. Take that political pressure that was building in the United States 2 years ago and multiply it against 26 member countries and all of the associated political parties. The potential for discord is clearly enormous. So the problems in Europe are really not over. The difference, however, is that this time they will be political, not financial problems. And if anything, those are only just beginning. Now, talking about Europe is one thing, but I think the thing that has been hiding behind the headlines is China. I think China is likely to have the greatest effect on the currency markets over the year ahead. And, again, full disclosure here, but I've been really lonely on my contrarian soapbox for years. But this year we're actually starting to see a wider recognition in the media of the flaws that are inherent in China's economic model. And, to outline what I mean here, the yuan has long been deliberately undervalued in an effort to subsidize exports and diminish imports. China maintains one of the lowest interest rates in the world, despite being one of its fastest growing economies. And state-owned companies operate pricing monopolies that allow them to set their own pricing levels across the Chinese economy. Now, if you look at this in the big picture, all of this is done to harness the efforts of private citizens and very subtly turn the fruits of their labors over to state-directed investment activities. So effectively what China is doing is it's taxing citizens' incomes, their foreign and domestic purchases, and their savings in order to build the export engine that has created so much of this growth that we've seen. And overall, this has worked incredibly well. Chinese household consumption as a share of the economy is the lowest in recorded economic history. This means that more than 60% of the money that China earns is being spent by businesses and governments. If the United States did something similar, for example, the results would be absolutely earth-shaking. We wouldn't be building larger houses. We wouldn't be investing in flat-screen televisions. We would be investing in fiscal infrastructure and productive activities. But the problem here is that the feedback loop in the Chinese economy is now broken. Businesses and state-managed enterprises are not allocating investment effectively, and inefficiencies are growing everywhere as a result. If you travel through China right now, you can visit empty cities, empty airports, hotels. You can ride on high-speed rail lines that very few average citizens can actually afford. And, you know, to me, these are outward signs of something very rotten at the core of the economy. Now, if you're feeling deja vu again, it is very much warranted. At one point in the 80s, Japan was doing something very similar. To this day, there are bridges, roads, and airports all over Japan that are largely empty. They even invented a term for it, actually, a hakomono, or a white elephant. But the crucial difference here is that Japan did not have the benefit of hindsight that China now has. Chinese policymakers have a sense of history. So what they're doing is they're taking steps to correct imbalances. They're raising interest rates and reserve ratios. They're letting the yuan float more freely, letting it float upward in a historical sense, privatizing businesses, and eliminating monopolies. So what we're seeing here is headline growth figures slumping as these reforms actually occur. And, you know, in effect, what this is doing is it's changing the shape of the Chinese economy. Appetites are shifting. So as households are given a greater share of income, the demand for raw materials is slowly weakening. And overall, this is actually a good thing. A sustainable, balanced China would be a fantastic asset to the global economy and would be a true trading partner to the United States. But of course, Western traders rarely do have a sense of history. So this year is likely to bring disappointment as China's appetites actually change. So when we look at the big picture here, I would suggest that we have four major forces coming together to create the conditions for a return to volatility. Economies are converging, meaning that much of the developed world is accelerating, the emerging world is decelerating. And this means that flows will become prone to reversals. This means that investment flows into the emerging markets are no longer a one-way street. At the same time, central banks are effectively closing the taps. While in public they're telling us that they are willing to pour more stimulus into the economy, both in Europe and the United States, there's a recognition that inflation will be the ultimate result of their activities. And this means that the supply of new money is doomed to fall. It has to happen. At the same time, China's uplifting effect on asset prices is dissipating. Perceptions are shifting incredibly rapidly, and I'd really highlight here that it's happening all the way down to the retail investor level. You're seeing that sequence of events in the media going from the large sophisticated news outlets all the way down to the newspapers that people are reading every day. And this means that the news out of China, particularly negative news, will continue to create havoc in the financial markets. So keep a close eye on countries like Brazil and Australia, where asset prices are heavily dependent on the Chinese growth picture. Now, probably most importantly, I think, we have elections occurring this year in roughly 40% of the countries that make up the global economy. So many, many challengers in many of these countries have every incentive to create upheaval, and many of them are likely to succeed in doing so. In this area, particularly watch places like France and China, where the established order is being shifted very subtly, and where the new entrants do have something to prove. So, in short, this time is not different in my own opinion. Volatility is definitively on its way back. Now, is this a bad thing? No, absolutely not. You don't have to be a foreign exchange trader to see the positive impact that volatility can have. After all, and you know, if you think this through, if volatility was bad, no retail store in the world would ever have a sale on its goods. No one would ever arrive and actually purchase. So mispricing in the markets continually creates buying and selling opportunities for companies that have the right processes in place. Companies that manage it effectively can distinguish themselves against their competitors both within the United States and on the global stage by becoming both more sustainable and much more confident in moving into international markets. So ultimately it pays to think like the best foreign exchange traders do. The best are fully aware that they cannot predict the future. They know that the markets will move, and they also know that sometimes they will move a lot more than at other times. And that sounds extraordinarily simplistic, but believe it or not, these two observations really are enough to build a strong trading program around. The trick is to strategically protect against risk while tactically harnessing short-term market movement, balancing risk and upside, in other words. And to do this in a corporate context, we need a process. We need a strong process-driven strategy, because that's the only way we're going to ensure that the bottom line is protected at all times and that the company is positioned to capitalize on market opportunities when they arise. And really, every strong trading program begins with developing an understanding of the business itself. I've seen this very many times where businesses run to their FX providers and ask for a hedging instrument before thinking about what they're hedging. It's a very, very crucial step to understand what's happening in the business itself. So long before choosing what hedging instrument is best, and even farther in advance than looking at the market itself, it's a good idea to start with understanding your I was going to say profit margins there, but more importantly, your operating margins. You cannot possibly protect the bottom line without knowing what the bottom line is. So think about your risk tolerances in percentage terms. Do you need to protect 60% of your foreign costs and revenues in order to ensure that your business survives, or is it 90%? And once you have that information in hand, then you measure your risk. So define your exposures. Now, broadly, you're going to have exposures related to actual or forecasted cash flows, and that's what we in the foreign exchange world will call transactional risk. But you're also likely to have economic risk. That is the risk that exchange rate moves actually threaten your business model. For example, if you're importing from South Korea and the Korean won surges in value, you have a very serious implication from an economic perspective. And some businesses that hold assets internationally are also exposed to translation risk in the sense that their foreign assets rise and fall in value as exchange rates change. So once you know where your exposures lie, it's then important to understand what they actually mean. What do they mean to the business? So perform a sensitivity analysis on each of your exposures and express the results in percentage terms. And this is not a terribly complex process, doesn't require any kind of rocket science, but think about how much exchange rates must move before your margins slip below acceptable levels. So when multiplied against your foreign costs and revenues, will a 5% exchange rate move push you below your sustainability threshold, or is it a 10% move that causes trouble? Once you understand these requirements, the next step is to develop a strategy that helps you to achieve them. You'll want to design a process and ideally write up a short document that outlines it. It should establish who is accountable and who they report to, along with the timelines that should be followed. It should also contain a list of the tools that can be used to achieve your objectives. And a lot of companies will call this a risk policy. I prefer to call it a trading policy as well, just to convey that you are looking for opportunity at the same time. But this strategy should force you to choose appropriately in advance rather than reacting to changes in the markets. And what do I mean by that? I mean that you need to choose tools that are going to fit your objectives long before something in the market happens. That is a guaranteed way to fail and to trigger losses. And I'm sure that most of you who tuned into the call today have heard a lot about the tools over the past few years. After all, providers sell the tools, not the processes. So I won't go into all the instruments in detail, but I will note that when we look at the instruments that can be used, they all essentially act on the possibilities that face you between now and a specified date in the future. All that you really need to do with this is to scenario plan, lay out what possibility range is acceptable, and then choose a tool that matches your risk profile. And so again, that can be done long before you touch the market. Why am I emphasizing all of this? Because a company is far better off deciding in advance what tools should be used under what conditions, as opposed to waiting for the markets to move in a certain way. If you have an understanding of when, how, and why you're going to be trading before you go to market, you can deliver superior results. And that brings us really to the fun part, and that is the fun if you're a foreign exchange nerd, I'm sure. But the intelligently harnessing short-term market movement in order to enter the market as efficiently as possible. And this really flows from a very basic philosophy. It's a good idea to begin by looking at historical volatility and then talking to traders about the upcoming events that might drive shifts in the market, volatility catalysts in other words. This will give you an idea as to where the most achievable opportunities lie. And in my experience, there's really only two types of market that we need to think about. The first is what we might call a normal market. The probabilities are evenly distributed on either side of the prevailing exchange rate because there are no obvious volatility catalysts on the calendar. Under normal conditions, over a 24-hour period, when we trade the US dollar against the euro, 30 basis points to either side of the prevailing spot rate are phenomenally likely, while 500 basis points are exceedingly rare. And so what we want to do is play this range. And this is fantastic because it means that there's a sale on every day. Every single day that you go into the market, there's a sale on. So using things like automated market orders, you can protect against large negative moves while capturing those strongly probable positive moves. As you can kind of see in this illustration here. In other words, this allows you to pick up small gains when the market moves favorably, but it also allows you to protect yourself when the market slides substantially in the wrong direction. So essentially what you're doing here is harnessing the law of averages without getting burned. And again, this is not, you're not doing any kind of thinking about what direction the market might go in. You're simply playing the odds. Now the second type of market that I think is extremely important is what I call a bimodal market. And this is when we have a big economic announcement coming up that is likely to move the market sharply in one direction or the other. In essence, there's no middle ground. And to give you a couple examples here, a Fed rate announcement, non-farm payrolls, things like tomorrow's University of Michigan Consumer Sentiment Survey, these are examples of situations in which we could see the market shift very dramatically in either direction. Now, in this type of market, what we want to do is we want to protect ourselves closer to the prevailing exchange rate because if the announcement is to the negative side, to the unfavorable side, what we could see is a very large slide in the wrong direction, and that could trigger a loss. So we don't want that to happen. On the other side, though, if the market does participate and does move in the right direction, we want to move our participation threshold farther out so that if the market does move nicely, we can ride the momentum for a while. And to mention something there, trailing stops do a phenomenal job of that. A trailing stop is a type of market order that moves up as the market moves in your favor. And I think they're phenomenal tools that can be used in a corporate risk management program without exposing the company to any sort of loss. And so to recap that, first we determine what sort of instrument would meet the business's long-term objectives, and then we choose the best method for putting that instrument in place. So strategize and then execute, and really, really think about that. Strategize first, then execute. And I think that execution phase is where a lot of companies are leaving a lot of money on the table right now. And there really are a lot of tactics that can be used under that umbrella, but they all build out from that basic premise. Now the last step in your process should always be adaptation. As Charles Darwin once said, it is not the strongest of the species nor the most intelligent that survives, it is the one that is most adaptable to change. And really that is the reality here. Businesses operate in a highly dynamic environment and go through a lot of change themselves over time. So even if it's only once a year, review and document the previous cycle, identify what's working and what isn't, and benchmark your performance against the company's needs rather than against the market. The important thing here is to bring predictability to your cash flows, not turn your company into a hedge fund. And based on this review, you'll certainly want to modify your process. So take the lessons that are learned and apply them in the next month or year, and your trading program itself will grow even stronger. So to summarize, what I've talked about here today, I'll be fairly blunt. Volatility has not gone away. It's simply in hiding at the moment. So prepare to manage the risks and seize the opportunities when it returns. And remember that exchange rates will very, very rarely move in sync with your business outcomes themselves. So in this environment, what you need to do is create stability so that your business can survive and thrive and so that it can grow. To do this, focus on generating incremental gains. And what do I mean by that? A few basis points every time you trade. If you try to earn a 10-cent gain on betting that the euro will fall, that's an excellent way to lose a lot of money and put your company's survival in jeopardy. So harness volatility and not direction. Exchange rates are guaranteed to move. They just aren't guaranteed to move in any particular direction. If they were, I'd be sitting on a beach somewhere drinking Mai Tais instead of hosting webinars here today. So always focus on improving your processes rather than on reacting to a particular situation in the markets. The interesting thing in this modern environment is that the media is distinctly alarmist. We always have big disasters coming up if you were to read the media. And that kind of thing actually causes companies to be overly cautious and overly greedy at other times as well. So above all, remember something that Mark Twain once said. He said that history doesn't repeat itself, but it often rhymes. So whenever you pick up the financial pages or look at the markets and experience a sense of deja vu, think about what your intuition is telling you and then start thinking about the opportunities that are about to spring into existence. Your bottom line will truly thank you if you do so. And I see that we're getting close to our allotted time frame here, so we'll move to questions now. Ernie, did you want to take it from here?
Yeah, thanks, Carl, for that great insight. At this point, we are going to launch our 2 polling questions. We would appreciate your participation in the polling question. Please note that for those of you in today's audience who are here for CPE credit today, you will need to answer both of the polling questions that we're going to get up on the screen and have up there for a minute or two. Again, if you have a question you would like to have answered by Carl, please ask it via the questions area in your go-to control webinar panel. So in the vein of using our great opportunity to ask Carl questions from the audience, I'll go ahead and ask and get Carl started on the Q&A as we have our polling questions up. We always love to have Carl as our contrarian. So someone is asking a question around, I believe from your presentation we can assume that you feel that in a sense the euro crisis is over, and there are those out there that feel that there could still be some restructuring of the euro. Can you once again let us know what are the things that you think that they might be missing on that front?
Sure. Okay, so right off the bat, I'd say that the problems in Europe have not remotely gone away at this point in time. What's happening, though, is the ECB is pouring so much money into the euro area that we're not looking at the same crisis we were looking at last year. It's changed flavor. So last year we were concerned about the financial system itself collapsing. We were concerned about contagion between countries posing a very large and dramatic problem in the short run. Now, this year, we're looking at a longer-term problem. We're looking at growth differentials that are not supportive in many of the peripheral countries. We're looking at competitive issues between countries, and we're looking at the fact that countries like Italy, Spain, and Portugal are all heavily indebted and potentially will require additional bailouts. Now, the fascinating part with all of this is that most of that does not really matter at this point in time. For traders that are playing the markets, what does matter is the fact that the ECB is pouring so much money in. So what we're able to do is borrow money in Europe and invest it abroad. This means that the euro should underperform on a continual basis as we borrow and as we invest abroad. But it also means that from a news flow perspective, that things are not safe, put it that way, in Europe. We're looking at a situation where we could see repeated panics, coming out of Portugal, coming out of Spain. Right now, we really are looking at a lot of concern in Portugal and Spain, and that's going to drive market behavior. But the reality is that we're not looking at an existential issue. I think last year the fear was that the euro itself would actually collapse. This year, that is not the case. We're not concerned that the euro area is going to collapse within the 2012 horizon, but we are concerned about what shape it will eventually take. So again, and kind of referring back to what I said in the presentation itself, we are looking at substantial restructuring in the years ahead. The only question really at this point is how fast that'll move and how close we need to get to the cliff each time before we do move ahead with restructuring.
Okay, great. I've got kind of a follow-up question to that question. So we're clear that you think the euro crisis is over, and you mentioned a few of the potential risks. What are a few of the top risks that you see that could happen that might change your mind on that front? Are there things that that are on the horizon that you see that might happen that might move that momentum back to that possibility that the euro may unravel at some level?
Sure. I'd say the number one risk is political, and that is that that voters in one or more of the larger European nations vote to install someone who is anti-euro. We have not remotely got to that point yet, at least in my perception, but politics is an incredibly unpredictable arena. So if we do see an upset in one of these countries and we have someone who is a Eurosceptic put in charge, we could see a breakdown in communication between the European leaders that are currently in place. And if that were to occur, and the new politicians were to stick to their guns, we could see a country making the political decision to leave the euro area or to default on its debt. And I think that's a crucial point there, is that default is almost always a political decision. It's very rarely driven by the financial picture itself. It's driven by people's willingness to pay, and that is something that's extremely vulnerable at this point in time in Europe.
Okay, great. Someone from the on the attendees has a question. They have exposures in the Australian dollar. Could you give us a brief overview of what you think, what's going on with the Australian dollar and your outlook on that front?
Absolutely. Australia is near and dear to my heart because I am based in Canada, and we are faced with a very, very similar situation. So what this phenomena is often called is Dutch disease. After what happened back in the 70s, when the Dutch discovered oil offshore and began to export a lot of it. What happened was that the value of the guilder surged, and the actual exporting industries within the country began to fail due to their reduced competitiveness. Now, Australia is facing something very much like this. One, it's extraordinarily exposed to what's happening in China, and two, the export industries that used to be relatively diversified and relatively structurally sound are now extremely vulnerable. Australia is making a lot of its foreign income out of things like mining. Domestically, what is it doing? It's spending money on, it's earning money driven by borrowing in the real estate sector. Now, and again, I should emphasize that's extremely similar to what's happening in Canada. Both countries are, aggressively expanding the amount of debt that is held by individuals, and are both slipping on the competitive level internationally. So the outcome that I would see for the Aussie going out over the next 12 months is weakness, and as a matter of fact, we could be looking at some weakness in the coming week in particular as the Reserve Bank of Australia meets. Expectations are rising at this point of a drop in the interest rate, of a drop in the benchmark interest rate. And the reason for that is because the Reserve Bank of Australia recognizes the need to trim some of the excess that's happening in the Australian economy and support business activity. In other words, they're looking to get ahead of any weakness that may come out of China. Of course, the effect that this will have if interest rate differentials do narrow, or that the Australian benchmark interest rate falls, is a drop in the Australian dollar. So, I think we're looking at an ongoing downgrading of expectations on Australia.
Okay, great. I'm going to switch gears on you a little bit, like I like to do. This is more on the execution side. And, someone is just asking questions around, some of the tools that are being used to execute trades. So how do you tools being used to trade foreign exchange currencies, and maybe something around touching on, maybe some current trends in technology out there, or just, just, you know, a very broad overview about some of the tools that people are using. Is that something you could speak to?
Sure. I think, and it's funny because we've held events around this in the past, but one of the key things that is changing in the corporate space is the adoption of platforms that collect data and the use of that data to manage foreign exchange exposures. The reality is that at one point you could spend 30 days out of every month without really considering where your exposures lay. At this point, you're looking at reporting cycles that are as narrow as a few hours, let alone a day. So we're seeing a widespread adoption of platforms that collect the data. At the same time, we are seeing more focus on what I was talking about there today, and that is, not just thinking about using forward contracts or swaps or whatever to hedge your future exposures, but thinking about how you actually enter the market in the first place. And I think that's a key thing because, if you are relying on those large tools, it's like using a shotgun. You're going to have a lot of collateral damage. You're going to have a lot of inefficiency. Whereas, whereas executing on a daily basis can mean that you're a lot more precise, and then you pick up those small gains each time without causing damage to the bottom line in the long run.
Okay, thanks, Carl. I find this an interesting question. As far as events or either economic or political in the United States, can you maybe give us your top 2 or 3 economic scenarios or political risk that would have the biggest impact on global currency markets in 2012?
Sure. Actually, I think this is a really cool question because I'm going to be very contrarian here again and say that the U.S. election is basically a non-event from a currency perspective. So I think that that's something that the media is definitely not going to run with. At the moment, there's a lot of sort of tumult around the election cycle, and that's having a major impact in the media itself. However, currency traders, they are looking at a relative level of stability in terms of policy making. They don't expect the boat to be rocked unusually from a presidential level this year, and therefore, I think that that's actually supportive of the U.S. dollar. From a surprise perspective, the key thing that I would be watching for is a shift in language from the Federal Reserve. So the Federal Reserve is, right now exercising a lot of moral suasion on the markets, trying to talk up markets, trying to talk up the economy itself, and really providing what I call a Goldilocks scenario for asset prices. In other words, they're saying that, if growth slips too much, they'll pour more money in. If growth accelerates, they'll keep the money where it is. And what that means for traders is that they have a known quantity. However, as the year progresses and as we see increasing stability in the United States itself, we could see a pivot in that type of language and that type of communication. And if that occurs, you could see basically some weakness on the asset price front, because the fact of the matter is that it is rather inevitable at this point that the Federal Reserve will eventually have to hike rates, have to begin withdrawing money from the financial system, and with the liquidity punch bowl being taken away, traders will be left to their own devices, and typically with their own devices, they need to rely on something much more fundamental. So I think that's a potential pivot point there as well. The third area I think again to talk about is the fact that a lot of the gains that we've seen over the last few months are partially seasonality driven. So we had a very strong shopping season at Christmas, and that created some momentum. The question at this point is whether that will remain durable, whether that will last. If it does not, if we start to lose momentum, we could see a fairly widespread sell-off in the markets. And again, that would have an impact on currency markets on a global level.
Okay, fantastic. Someone is asking what I see is another compelling question. You touched on this a little bit maybe touch on this a little bit. Someone's asking if the third world countries played any changes to the equations that we're looking at, and then if we look to China and their relationship with the third world countries, could that have some impacts in 2012, and what might those be?
Very much so. So the reality is, and it's funny because you look at the different groupings in the world, and there's the developing world, the third world, the second world, the BRICS, for example. You have all of these different country groupings, but what a currency trader looks at this point, and really a lot of traders look at, is what we might call China proxies. So countries that are going to grow if China grows. And I definitely singled out Brazil in my discussion earlier as one of those countries that is very, very strongly weighted toward exports that go ultimately to China. In other words, raw materials that are demanded in the construction industries in China. Those countries are exposed to vulnerability in the coming year. And that comes from really two directions. The first is the fact that, that exports may weaken. The second is that countries like Brazil have been recipients of massive amounts of foreign investment, whether through ETFs, emerging market ETFs, or through private equity groups investing from overseas over the last few years, and those flows are also very vulnerable. So the key thing that I'm watching is not necessarily whether exports to China fall, but whether the perceptions of exports to China change. In other words, whether the retail investor in the Western world decides that emerging markets are not that safe. And if that is the case, we will see an impact throughout the emerging world. Now, ironically, this could actually be good in the long run. I think that prices have risen maybe perhaps past fundamentals in many of these countries, including the prices of raw commodities like rice, for example, wheat, things like this that have risen in price as the emerging markets have surged ahead. If those prices fall, we could actually be seeing a more sustainable future for those economies. So it's not necessarily a very bad news phenomena, but I think Western perceptions are definitely vulnerable to a change here.
Okay, here's another question, which is interesting. It seems to be along your contrarian view. So some of the talk about the euro is maybe in the euro breaking up. Someone's asking a question around, there's been talk last year about how the U.S. currency is no longer the global currency. So what are your thoughts around consolidating, towards a global currency that's a basket of currencies, and do you think that that would solve anything in the volatility?
Okay, well, sort of an interesting question because there's theory and there's practice. In theory, a basket of currencies, special drawing rights, for example, would have a lot of validity because they could be tailored to eliminate volatility and to reflect global trade flows. However, in practice, that's not necessarily achievable. The first thing is that I think it's roughly 68% of global trade right now is denominated in the U.S. dollar. China's renminbi is slowly moving up, but it's less than 3% of global trade. The euro is a large trading bloc, but it's nowhere near supplanting the U.S. dollar. And the problem with that is that in order to shift from one reserve currency to another, you really need to change the decisions of billions of people, not simply a central bank. What do I mean by that? When China, for example, purchases U.S. dollars to hold as its reserve currency, what it's doing is creating a lever, or sorry, I should say, it's creating a weight to put on a lever. In other words, it's creating something that it can manipulate against the U.S. dollar in the future. In other words, they can sell and buy U.S. dollars in the future in order to hold the value of the renminbi stable. And this is the case across most of the world. Countries are building up U.S. dollar reserves for the simple purpose of being able to move the value of their own domestic currencies against the U.S. dollar. So until trade flows change, there won't be a change in the reserve currency that the world is using. Kind of an unfortunate reality. So, one, that creates issues in terms of volatility, but two, it also creates pressure on the U.S. dollar itself. It means that a lot of countries are forced to recycle their currency reserves into U.S. dollars. Will that change? Maybe over 20, 30 years, but certainly not in the trading horizon that anyone on this call is likely willing to play. Put it that way.
Great, thanks, Carl. Here's a question from someone who is managing foreign exchange for their company, and and as you noted before, sometimes people will come at you with all these hedging instruments. So for someone that is not a currency expert, renowned currency expert, such as Karl Schamotta, do you have advice for them in how to understand the opportunities and how to convey those to those they want to execute for them, and then get them on board with the company strategy on that front?
Sure. That's a great question, and it's funny. It's really near and dear to my heart. I always think about this, that one of the things that professionals can do is actually taint results with overconfidence. In other words, they look at so much data that they have the perception that they know what's going to happen. There's an old saying too that professionals built the Titanic and amateurs built the Ark. One sank. The situation here is that for the average business, the key thing that you need to do is to really identify a couple of very basic variables. The first is your operating margins. The second is tolerances within your business, within your existing set of stakeholders for risk. And the third is sensitivity. So in other words, thinking about how much exposure or how much exposure can be handled conceivably. With that information, if you work with a consultative foreign exchange provider, you have enough to build yourself a sustainable program. And the key is, of course, a consultative foreign exchange provider. If you simply call up your bank and ask for a certain product, you're not going to get a consultative approach. You need to work with a group that actually does, go into your business, understand what's happening, and then give you a proposal based around that. And speaking of what we were seeing changing in the market over the last few years, I'd say that that's a huge change, particularly in the United States. You're seeing more companies shift toward that consultative approach, that really in-depth approach with their providers versus the historical process, which was to develop your own strategy and then call your bank and ask them to execute on it. And I think this is a really positive thing. So, again, harness the power that you have as a non-professional to keep things on an even keel, but use the professionals to add polish to what you're doing.
Okay, perfect. As far as, what you still see, and what you talk to folks that manage FX risk, what would you say are the top 3 mistakes that people make in terms of either getting their arms around their exposures or on the execution front? Okay,
so good question, and it's funny because I certainly see this from my own perspective. The number one, hands down, biggest issue is overconfidence. That is having a belief that markets are going to move in one direction or another. And really that was the subject of today's webinar, was the fact that, right now a lot of people are overconfident. They're thinking that we have stability in the future, that we have nothing to worry about. That can be a fatal flaw. The second big issue is not maintaining a disciplined approach, not doing the same thing regardless of what is happening in the outside world. With hedging, you need to keep your head down. You need to make sure that you're doing the same things day in, day out, that the bottom line is always, always covered. That needs to be agnostic. It needs to not be driven by what's happening in the market. It's kind of debatable what I would say the third largest issue is. But again, I think one of the things, and you and I have actually had discussions offside about this before. But one of the other big issues is focusing too much on foreign exchange at times, where you get CFOs that are watching the screens all day instead of focusing on the core business. So you have to find ways to offload that monitoring aspect of what you do.
Okay, outstanding. With that, and the sake of our time, I'd like to close the Q&A session. I would like to thank Karl Schamotta for his time and tremendous insights. If you'd like us to connect you with Karl, please indicate on the survey we will invite you to take that will pop up on your screen just as soon as we end the webinar today. Karl is certainly a leader in his field and is an excellent source of information on today's topics. Thanks again to our sponsor, Western Union Business Solution. As a reminder, for CPE credit, if you did not check the box on the way in to receive CPE credits, please send an email to Dawn Moore, dmore@performative.com, that is on the screen. Again, please note we will be launching our survey directly after the webinar is over. We very much appreciate your feedback on our event today. We always strive to maximize the ROI to our attendees. Finally, I would like to conclude today's webinar by thanking you, our audience, for your valuable time, and we hope to see you on performative.com in future events. Make it a great day, everyone. Thank you.